All right, let's jump right in. Today on Talk Tickers, we're breaking down the latest earnings from product tanker giant Hafnia, ticker HAFN. They just dropped their Q3 2025 report, and, well, it definitely caused a stir. So check this out. On the day they reported, the stock immediately dropped over 3%. Now here's the kicker. Management was on the call telling everyone it was their best quarter of the year. A drop on their best quarter? Yeah, that's a head scratcher, and that's exactly the mystery we're going to solve today.
Okay, so first things first. To figure out why the market reacted that way, we've got to look at the numbers they were looking at. Let's dig into the Q3 results.
So the big number they reported was 18 cents a share in earnings. On its own, a number like that doesn't mean a whole lot. It's all about the context. What were people expecting?
And boom, here's that context. The revenue number? Pretty much dead on the money, right where analysts thought it would be. But the earnings per share? That was a big mess. We're talking an 18% miss. And listen, for a stock that's been doing well, when you miss the bottom line by that much, the market is absolutely going to notice.
Okay, but there's another layer to this. You got to compare this quarter to the same one last year. And whoa, what a difference. We're seeing a massive drop in profit and EBITDA. Now, this wasn't a total surprise, right? 2024 was a super cycle for these guys, an absolutely amazing year. So we knew things would cool off. But actually, seeing those numbers in black and white, it looks like that was the trigger for a lot of people to say, you know what? I've made good money on this stock. Time to sell and lock in those gains.
But hold on, it's not all bad news. A huge, huge part of the Hafnia story, the reason a lot of people own this stock, is the dividend. And they didn't disappoint there. They stuck right to their policy. 80% of the profits are going right back to shareholders. That works out to a dividend of just under 15 cents a share. And this is the 15th quarter in a row they've paid one. So for anyone invested for the income, this is exactly what they want to see. It's the bedrock of the whole bull case, even when earnings take a little hit.
All right, so that's the market's take. Now let's flip the coin and see what management had to say. Because, well, they had a very different story to tell.
So you have the CEO, Michael Scove, coming out and saying, hey, I'm pleased this was another excellent quarter, our best one this year. I mean, listen to that language. Excellent, best quarter. That's a world away from how the market reacted, right? And this is the real tension here. Is it a short-term miss, or is something bigger and better being built underneath?
So to back up that positive talk, management laid out their game plan. Basically 5 key things they're working on. First, they're upgrading the fleet, selling off the old ships, bringing in new ones. They're also making a really interesting move, buying a big chunk of their competitor, TORM. And while they're doing this, they're making their balance sheet stronger, growing other parts of the business, and, this is key, slashing their operating costs for the future. And you heard me mention that term net LTV, or loan to value. This is super important for Hafnia. Think of it like the mortgage on your house. It's their debt compared to what their ships are actually worth. Why does this matter so much? Because for Hafnia, that number directly controls how big of a dividend they can pay out. The lower the LTV, the healthier they are, and the more cash they can give back to you, the shareholder.
Okay, so if the strategy is so great, why did they miss on earnings? What went wrong? Well, management was pretty upfront about it. It was basically a temporary operational hiccup. They had way more off-hire days than they planned for, about 230 extra days where ships were in dry dock for maintenance instead of out earning money. The good news? They said that's mostly behind them, and Q4 should look a whole lot better. That could be a nice little tailwind for the next earnings report.
All right, let's connect the dots here. We've got management's rosy picture versus the market's initial thumbs down. Let's break down the market's final verdict.
Which, brings us right back to that big question. How on earth does a best quarter of the year report lead to the stock getting hammered? The stock's price chart from that week tells a really interesting story. On earnings day, you see this big red candle. It drops 3.2% on heavy volume. Ouch. But then, look what happens over the next few days. It climbs right back up and erases the entire drop. So what does that tell us? It suggests the first reaction was pure emotion, a knee-jerk sell-off. But then, the more strategic investors stepped in. So here's our take on what happened. The initial drop, that was the short-term crowd. They saw the EPS miss, they saw the year-over-year numbers coming down from that crazy supercycle, and they just hit sell. It was a classic take the money and run situation. But the recovery that followed, that was the long-term money. The folks who said, wait a minute, the dividend is still solid, the strategy makes sense, I'm buying this dip.
So that's the story of Q3. But what about Q4 and beyond? That brings us to our segment, The Next Call, where we give you our rating and our take on what happens next. So when you look at Hafnia today, you really got two competing stories. The bulls are going to tell you, look at that juicy dividend yield. The balance sheet is a fortress. Management knows what they're doing, and there aren't enough new ships being built to kill the market. But the bears, they're going to fire back with, the best days are in the rearview mirror, that TORM deal has risks, and hey, maybe the stock has just run its course for now. So where do we land? After weighing both sides, we're slapping a market perform rating on Hafnia. Here's why. That dividend is so strong, it puts a real safety net under the stock. But at the same time, earnings are coming back to earth after a huge run, and that's probably going to keep a lid on the price for a while. It's a solid company, just maybe not one that's going to shoot the lights out in the next few months.
But you know we always have to leave you with an outrageous but plausible trade idea. And here it is. The core idea is that the market is too focused on the short-term earnings dip and is completely missing the long-term gold that management is mining with the TORM investment and the new fleet. So if you believe that value will eventually get recognized, how could you play it? Well, one idea is to look at options, specifically the January 2026 $7.50 calls. This gives you over a year for the thesis to play out and offers leveraged upside if you're right and the stock makes a move higher.
And that's our breakdown of Hafnia's wild third quarter report. It's a really fascinating story of short-term numbers versus long-term vision. Of course, remember to do all your own homework before making any moves. This is not financial advice.